All right, today's webinar is going to be on assuming a multifamily loan for apartment syndication, and we're going to be diving deep into why a seller would prefer you to assume their loan, the timeframes to expect for assuming these loans, what the lender is going to require, and when you might consider just getting new debt versus assuming somebody else's debt. So we're going to answer those 4 questions and dive deep into those, and then we'll open it up for our live audience to be able to ask any questions, and we will answer those live on air today. So thank you so much for all of you joining us. We have over 100 people live on the webinar with us today, had several hundred register, and looking forward to providing this information. For those of you who don't know who I am, I'm this little guy down here at the bottom. I say little with tongue in cheek a little bit, but Dan Handford. I'm one of the managing partners of this group called PassiveInvesting.com. And you can find out more information about me by going to Meet the Team. And you can click on Dan Handford there, have a special video there talking about how I'm married and got 4 children, 3 girls and a boy. Have also a standard poodle that we have who's going on 5 years old now, and how my business background and where we are today as far as our properties are concerned. If you're interested in joining us on one of our future properties and you would like to find out more information, you can go to this website. On the top right-hand corner, there's this thing called Join the Passive Investing Club. You click on that. There'll be a form that you'll fill out. That form will allow you to have a phone call with me. I will jump on a phone call with you, discuss your investment goals to see if we're the right fit for you. So I will leave that to you to be able to do that so that you can find out more information. For those of you who are joining us live, I will type it into the chat box. If you want a hyperlink to it, you can jump right over there. The last thing I wanted to mention is about the MFI and Summit. It's a it is an online virtual event all for multifamily investors. So you can go to mfinsummit.com. This next one coming up is June 11th, 12th, and 13th, less than 2 weeks away from today. So make sure you register. If for some reason you are listening to this after June 11th, 12th, or 13th, we do not sell the recordings. So you cannot get access to this event once it passes. Those recordings are locked into a vault, and only the people who paid for a ticket during that event will have access to those recordings. So if you want to register for our next one, you can still go to MFI and Summit. You can find out more information about the one that's going to be coming up in January 2021. So without further ado, let's dive into this event. I'll dive into this topic for today about assuming a multifamily loan. So first off, why would a seller prefer you to assume their loan, right? And one of the main reasons why they would want you to assume their loan is because there's what we call prepayment penalties, whether it be a step down prepay or yield maintenance, which causes them to have to it costs them more money to be able to exit that loan. And so if they don't get a buyer that will assume that note, then they typically can't sell the deal because it costs them too much to sell the deal. And to give you a quick underlying explanation as to what yield maintenance is the yield maintenance is where if you have a loan at a certain interest rate, let's just say it's at 6% or 5% or whatever the case may be. Let's just say 5%. If you have an interest on a loan at 5%, and then in say 6 years or 7 years on a 10-year term, you go to sell that deal where you usually have yield maintenance, where if the interest rates are lower in the future than where they are at the current interest rate that you have to pay the difference between those two rates for them to replace that capital somewhere else. Now, on the other side of it, we wouldn't even be having this conversation if the interest rates were higher, right? Because if the interest rates are higher than where they are when you first got that loan, then there's not usually that much yield maintenance available. There's not usually that much yield maintenance to really make a big deal of it. But this yield maintenance is something that can make or break whether or not a seller can sell a deal and whether or not it can be assumable. And so that's one of the main reasons why they would prefer you to assume that loan, is because there are pretty hefty prepayment penalties. One of the problems is that usually the lender is a lot more strict or stringent on the qualifications required to be able to assume those types of loans. They can, as far as the time frame is concerned, a lot of these loans I've heard can take up to 6 months to process. And so it's a little bit more of a lengthier process to be able to get it done. But I've seen some of them get it done within 30 days. So it really just depends on the lender and how fast it can actually happen. But a lot of it has to do with the strength of the new buyer that's coming in, and whether or not they will allow that new buyer to be able to take over the new debt and not change the terms on that new buyer. So that's a big thing to think about when you're doing this, because when we do typical syndication, we're usually going to be raising all of our funds from contract to close. And those investors' returns don't start until you actually close on the property. So if you close on a property or if you don't close on a property for 6 months and you're holding on to that investor's capital for 6 months, that's a lot of time for an investor to, be holding capital with you. And so it sometimes is one of those things that can take precedent when trying to get investors' capital, is that they don't want to sit there and place capital with you because you're assuming a loan that is already in place. The next question here is what is a lender going to require in order for you to assume that loan? Before we go into that, well, I'll answer my next thing. The next thought that came to my head in that last question we have. A lender is typically going to require the same information from you and requirements from the beginning from the initial underwriting of that loan and for when transferring it over to you. So what I mean by that is there's typically 3 requirements for qualifying for these types of loans. Number 1, you have to have net worth of the loan balance in order to be able to sign on these loans. It's of the loan balance, not of the purchase price. It's of the loan balance. So you have to have net worth of the loan balance. The second thing you have to have is you have to have liquidity, which usually is about 10% of the loan balance. So let's just say you're going to get a $10 million loan. You got to have $10 million of net worth and $1 million of liquidity in order to show that to the bank to be able to be signing on these non-recourse loans. That's going to be the same thing that you're going to have to do when you go to assume a loan as well. So you can't, quote unquote, assume, right, that they're going to change those things when a new buyer comes in. It's going to be the same qualifications. They have to meet those requirements the same way, right? You can't get around those. The third thing that they have to have is experience, right? And that experience is managing these types of investments. They have to have experience managing these types of investments in order for this to work. So when might you consider getting new debt versus assuming someone else's debt? Looks like Dee Dee actually has a question here before I dive into that last topic there, that last question. I'm going to eventually be selling my assumable loan through Freddie Mac. So can you also cover this information from the selling side as well? Well, a lot of it has to do with finding the right buyer on the sell side, right? And so we're going to talk about why somebody would, in this last question, why somebody would want to use your debt versus assuming or using your debt that you already have versus getting their own debt. And a lot of it can be balanced by a higher purchase price to help you with that yield maintenance. And it also can sometimes be a no-go, because if you have to be able to assume that note, a lot of times it's a lot harder to find buyers for deals that you're trying to sell the deal with them, assuming the current debt. And so it can take a little bit more time on there as well. Let's see. Are there any type of accounts other than, James asking this question, are there any type of accounts other than traditional banks where investor funds can be placed so they can at least earn some interest while waiting for the assumption process? So the only real place that you can place that capital, because you can't risk that capital, right? Because you have to protect it. It's not your capital, it's the investors. So the only real account that you can put it in is some form of savings account or high yield money market or something like that, which right now with the current pandemic are usually down around 2 or 3, 0.2 or 3. It's like 20 or 30 basis points, and that's it. Now, before the pandemic, we could stick it into an account, which would give us about, 1.5%, somewhere around in there. So you can get some return off of it. But a lot of these investors still aren't going to want to put their money in and only get 1% interest on their money. They would rather put it back put it back to work somewhere else so they can not have to worry about losing so much money on that. What about purchasing subject to? Is that suggested? So it's a whole other topic, Dawn, to talk about subject to, but we're not going to talk about that today. I can go on a whole other level of detail in regards to the subject to, but I'll put that on the list and possibly talk about subject to financing in the future. on one of our future webinars. So just make sure you stay tuned for some of our future webinars. So I'll definitely talk about that. And for those of you who are not part of, or maybe watching the recording, if you're watching this live, you're on our email list because you're getting the emails, or you registered somewhere where you found the webinar, and we're going to be letting you know about future events. You'll also get recordings to this event as well. But for those of you who are watching this on the recording and may not have registered for one of our events before, or our webinars, we do a weekly webinar every single week, and you can go to multifamilyinvestornation.com/MFIN webinar to find out more information about the next event that's coming up. So every week we have a different event that's coming up. And when we get done here, I'll be refreshing the page, and there will be a different topic that'll already be ready for us for next Thursday, June 4th, I believe is next Thursday, June 4th. And we'll be diving into that topic. So let's talk about this last question on here, this last topic that I wanted to talk about. And for those of you who have questions as you were on here, feel free to type them into the chat box or into the Q&A box, wherever you wish to put them. And I will go through each one of those questions to be able to dive into them further. So the last thing here is when might you consider getting new debt versus assuming someone else's debt? So there's a couple of challenges when it comes to assuming somebody else's loan. If it has an attractive interest rate, and maybe that in the current environment, the interest rates are higher, then it might be more attractive for you to assume somebody else's loan. One of the caveats to assuming someone else's loan is if they are outside of, well, even if they're outside of if they are outside of their interest only period, obviously they've been paying down principal. And so that loan to value with the new purchase price is going to be lower than what you would probably want to have in some form of debt. So you might have to bring on another lender from what's called a supplemental loan financing or mezzanine debt to be able to put it on top of that project to make it work. So it can be a little bit more challenging for somebody who's not an all cash buyer, because they're going to be able to, they would want to get new debt to be able to leverage up, right? And so on the other side of it, if you are in an environment where you have a higher interest rate. So let's just say right now in the current environment, you have that 5% interest rate, and you're trying to get someone to assume that loan. Well, your purchase price through that buyer is going to have to come down, because that interest rate is higher than where we are right now in the current cycle. And so right now we're in the cycle, we're down to around 3.25 to about 3.5, maybe 3.75% interest as far as interest rates are concerned. And so it would be better for somebody to, if they could, to be able to exit that deal, to be able to do it. So you kind of have to balance it both ways to realize if they assume the loan at a lower purchase price, would it be better for you to just pay the yield maintenance and be able to sell it at a higher price? So you have to do that underwriting analysis on the back end when you're selling that deal to see if it actually makes sense, and making sure that you actually get that BOV, that broker opinion of value of what that property could sell for, if you could get top dollar for it, given the current interest rate environments, and balance that out. Could you actually get a couple $100,000 more for that property and be able to use those funds to be able to pay off that yield maintenance? Or would it be better for you just to have somebody assume the loan and actually pay a lower purchase price? So you have to just run those different scenarios to see which one would actually be best for you. So looks like we have a couple of questions coming in here. And so Sathesh is asking, when we assume the existing loan of the seller, do we need to pay difference of equity to the seller? Yes, that's correct. So let's just say they bought the deal for $10 million. They put a loan on it of $8 million. So it's an 80% loan to value. So now they have $2 million in equity. Let's just say they've been paying down the loan, and now the loan balance is $7 million. But now they're actually going to sell it to you for, say, $12 million. Well, now you actually have $5 million in there that you got to come to the table with, because you're going to assume the loan at a lower loan to value ratio because you're buying it at a higher purchase price, and they already brought initial equity. And they've also started to pay down that loan. So you have to pay that difference. And that's where you have to balance it and say, okay, do the numbers still make sense to be able to assume it and bring in more equity, or should I try to find some other type of secondary position, lien holder, loan lender to be able to help you take down that $5 million? Let's see. Most commercial DOS clauses are triggered by giving another party any interest in the property, even something as simple as an option to purchase. Can you talk about dealing with a DOS clause? Let's see here. I'm not really following what the the question is. Maybe elaborate a little bit more about what you're referring to there, because the due on sale clause would be in place if you were uh, okay. So let's back up here for just a minute. So let's talk about this due on sale clause and why it would be triggered. So if you are in the beginning stages of acquiring a property, one of the things you need to be making sure of is that the new lender will allow you to have somebody else assume the loan when you sell it. So if that's not a possibility or an option, then you might not be able to sell the property because of yield maintenance or prepayment penalties or whatever. But in the very beginning, if in your business plan you are trying to exit that property early and get out of that loan early, you need to make sure you have that exit strategy available, right? So you need to make sure that you have the ability to be able to bring on another group to be able to acquire and assume that asset, and it doesn't cause you to have that due on sale clause. Okay. All right. So I don't see any other questions coming in here. So and if there's not any other questions, I will end the end the webinar early today, which is perfectly fine. Let me refresh the screen and see if we're ready yet for the next one coming up next week. Doesn't look like it's updated just yet, so we might be finishing up that as we're doing it. Let me see if I can type in this in here and see. Nope, not yet. It's still in the process of being updated. So we usually do that in the background. I have somebody that works on that very carefully and updates that, and we don't always get it done right away. Usually towards the end of the bottom of the hour that we get it done. So for those of you who are following us, obviously we'll send you an email about the next topic for next week. And for those of you who have not registered yet, please go to mfinsummit.com, register for the next event. It's coming up in less than 2 weeks. You can see the little ticker there, less than 14 days, 13 days, 19 hours, and 36 minutes. It is an amazing event, and I promise you will not regret it. And I'll even give you a 100% money back guarantee if you would like to if you go to the event and it is not working for you. So and you don't like anything about it. So just do that, go there, find out more information, register for the event. You can also go at the bottom of the event page. You can see the entire speaker schedule and all the topics that are going to be having on this event. So make sure you go there now, register for the event. And I appreciate I appreciate you coming in and joining us, and looking forward to seeing you on the next webinar.